Did you know that 88% of the S&P 500's moves can be predicted using just two economic indicators? By the way, those are the ones we'll be breaking down in today's video. But before we get there, I want you to download your free Excel and PDF guide with link below. With that, you could follow along and break down the reports with us. So on that note, let's get into it.
All right, welcome back to the desk. And like I said in the intro, today we're going to cover the manufacturing and services PMIs and how they're all connected with the recent tariff announcements by President Trump. As you may or may not know, that trade conflict between Mexico, Canada, the US, and China is just getting started. But we think that these new policies are going to bring about a shift in both bonds and the dollar. And of course, that's going to create a massive rotation in the S&P 500 and the NASDAQ. So all of that we're going to cover today. And without further ado, let's get into it. So the summary for today is, first and foremost, we're going to start with the price action between different asset classes and what the volatility means as far as the broader narrative that is happening in the markets and how we connect that narrative to macro data such as the PMI reports. So after that, we're going to go over the last month's PMI, manufacturing that is, which we already covered in our previous YouTube video. So if you haven't watched that, I would say save it for the queue and then go and watch it again after this video so you have a pretty good idea of what's happening, what the broader trends are. So that being said, we're going to go over the current manufacturing PMI and spot the themes and trends. In other words, make the connections between this PMI and last PMI and see why commentaries and every other piece of data is driving us to find the best stock ideas in this sector. After that, we're going to introduce the services PMI, which we didn't cover in the last video. And then we're going to connect both the manufacturing and the services data, and as well with the narratives that we have derived from the price action in asset classes. So after that, we're going to have a pretty good idea of what manufacturing is doing, how that is connected to the rotations in services, and how all of the price action in different asset classes are going to lead us to pick a stock to buy and break it all down in one single space. So again, this is how 85% of our trade ideas come along and how I learned to come up with portfolios and trade ideas when I worked at Goldman Sachs and Citigroup. So let's move on to the price action, first of all, for the S&P 500. Gotta stay hydrated. So since January 2025, we've had a few rounds of Trump tariff announcements. And of course, that's created a lot of volatility, as you can see in the chart. We've traded around the 5950 to 6150-ish range on the S&P 500. This is the futures, by the way. So it's not going to be exact if you're looking at the index itself. But anyway, we have met both responsive sellers and responsive buyers, as you can see in the circled areas in the chart. What that means is the auction gets really aggressive on the volume cutoffs. So you can see the volume profile in turquoise behind the chart, the bar chart. And when that volume cuts off, it means either responsive buyers or continuation sellers are going to come in at the bottom, or continuation buyers or responsive sellers are going to come in at the top. So we have been seeing all over the past month a range that makes me think of a distribution. So distribution in what sense? Well, the S&P and the triple Qs, the NASDAQ, have been very heavily weighted on the Mag 7 big large cap tech like NVIDIA, Apple, Microsoft, Google. And as you've seen recently, those have lost a bit of momentum. And the XLI or XLB, which is the industrials and basic material sectors, the ETFs, they have been breaking out a little bit. So these ETFs, they pick their holdings based on momentum, essentially. So right now, as tech starts losing momentum and industrials, basic materials gain momentum, it makes sense that this range in the S&P 500 means somewhat of a distribution. That means the big hedge funds, the big pension funds, the institutional holders commercial, so to speak, they're looking to distribute their holdings here and then adjust if that volatility comes. So let me explain this further. We're going to look at the price action in bonds. And bonds right now have been the flight to safety during these volatile periods when Trump announces new tariffs. And this is important because it's usually gold and dollars, not bonds, that call the flight to safety over the past 3 years, 4 years. So the narrative is starting to shift because we saw the dollar not react that much. We saw gold not really react that much, even though after the tariffs, it hit a new all-time high. But what we really saw jump was bonds. And this is the TLT ETF. So this is like long-term bonds, 20 years plus ETF. You can look at TNX if you want to look at the 10-year ETF holdings. So anyway, since the market decided to fly into bonds instead of dollars and gold, we think that the risk reward in bonds is being accepted by the market in the sense that right now, the low price in the TLT and the high yield is pricing in the wrong narrative, which is inflation. And we have no reason to believe right now that there's an inflation scenario to come. If anything, all the data, all other indicators that we're looking at suggest that a potential recession scenario is the one that should come, is the one that should play out here. So, knowing that, we think that bonds have the best risk to reward ratio when it comes to asset classes. And it's being shown by the price action how capital is just flying into bonds, not dollars, not gold, when volatility breaks out. So that being said, we think that the narrative is starting to play out, and we can confirm it with the price action in dollar spreads specifically to bonds. So as you can see on the left chart, that's the volatility or delta adjusted spread between TLT bonds and then DXY dollar index. As you can see, we are at cyclical lows that were hit in late 2022, late 2023, and then early 2025. And each time that happens, we can overlay it with the S&P, but each time that happens and we have a quick adjustment to the upside, the S&P sells off. And, that's starting to fit the narrative here where dollar sells off, bonds rally, and the narrative is still under recession, not inflation. Because if it was the opposite way, such as it is right now, the spread hitting the historical lows, that would mean inflation. And that makes sense to see all the asset price, or the asset classes price action right now. But as we hit that bottom and we started to rebound, as you see in the bottom left chart, it means that inflation premiums are fading. And I think recession ones are starting to come in. And if you go to the right chart, you'll see it in a more zoomed in basis. This is not the spread. This is the dollar index in white and then the bonds in orange. And you can see those are pretty stationary when it comes to the spreads. And what I mean by stationary is they usually deviate by a certain amount, and you can just see them right back. They just come right back. It's like a magnet. So, combining those two, you can see that they are now deviated to a limit, statistical limit, and they have to come back. And the only way for them to come back is for bonds to rally and dollars to sell off, which, again, it's not inflationary, it's recessionary. So we're 2 for 2 now in price action, and we're about to be 3 for 3. So right now we have the price action in value spreads. Let me explain what value spreads are, first of all. We have the IVE ETF, which is for value stocks. And then we have the IVW ETF, which covers growth stocks. And you can see on the bottom left chart, again, the volatility adjusted spread or delta adjusted spread. We are at cyclical lows, not seen again since late 2022. Let's go back. The late 2022 also saw the bottom cyclical spread between bonds and dollars. So we have two pretty reliable indicators or spreads that signal a coming rotation in the market, which should follow a crash. Crash meaning sell, right? I'm not calling for like a recession, like 2008 scenario. We're going to see an 80% sell-off in the S&P. No, I'm just saying that the S&P has to deleverage, and the dollar bond spreads call for it, and also the value to growth spreads. So what that rotation into value and out of growth would mean is the S&P and the Nasdaq have to rotate out of the bloated growth stocks like Nvidia, Amazon, Google, where those stocks need to come down. And you've seen it already with recent earnings announcements. Like, I think, if I'm not mistaken, Amazon dropped by 8% just last week on earnings. Google dropped by a similar amount, and we'll see what Nvidia does. I think they report on the 26th. So, I don't want to speculate on what's going to happen to Nvidia, but if it's going to follow the broader trend in large cap growth tech, then I don't know, might be going down. But anyway, when these bloated growth stocks in tech lose momentum, like I said at the beginning, money has to shift, and it has to shift into value. It has to shift into risk-adjusted setups, risk to reward. So in other words, value. But where is the value going to be found? That's an answer we're going to go over in a minute. But before, I want to recap the manufacturing from last month. So in this slide, which is the picture I've put in from the last presentation, we said that we saw some bullish developments in the PMI, but it wasn't time yet to start buying and start going crazy for manufacturing stocks. We needed another month of expansion in the index itself. We needed new orders expansion, trade expansion, and employment. Well, we got it. So, last month we saw the expanding trade, so exports minus imports, and then we saw a slight shift in the commentaries, as you see in the bottom right. We highlighted the increase in demand for electrical equipment, manufacturing, primary metals, and plastics. So we did want to go along those industries, but we didn't want to jump the gun. So let's see what it's looking at, or what it's looking like for this month. Are we still in that theme? And looks like we are, because we just had the first index expansion, or a reading above 50% in 28 months. So the narrative is definitely starting to shift, and the market has to adjust. As we said, it has to adjust based on momentum, which is going to follow the more data we get like this. So my guess is we get another month or two of positive, bullish manufacturing PMI data. And my guess is stocks are going to start to break out, and then the indexes have to adjust, and we have that rotation happening. So this time, new orders led the way again, just like last month, but this time with a 55.1% reading. So this is extremely bullish because, as we covered in the last video, readings that are closer to 50 don't really tell us much. But once we go 53, 54, 55 like this, then the trend is undeniable. It's very, very clear. So you can see it in the bottom left and bottom right, how both the new orders and the index itself expanded. So we can follow that theme and drill deeper into it. So we want to find the industries, as we did last time, that are breaking out within the manufacturing PMI. So first of all, this is the third month of exports outpacing imports. And not only that, they've been doing so at a growing rate. So what that means is trade is starting to happen again. And for trade to happen, we need customers, like foreign customers that are buying our goods, and domestic industry to, one, be expecting an easier environment to trade in, so lower interest rates, which is something that President Trump is already asking for. And also, we need a lower dollar. Why? Because a lower currency, a weaker domestic currency, would give foreign buyers relatively better pricing power, relatively better buying power. So both the narratives that we covered before in the spreads for value and currency bonds, it's already playing out in the economic data. So, with that being said, as far as the trade activity, we have to look at the imports now, the commentaries now. And for machinery, which was one of the industries we wanted to go long on last month, commentary says outpaced normal levels for this period of time, so more demand. Now, for fabricated metal, we have strong start is unusual. So they're seeing a stronger start to the year. Why? Because everyone is now expecting a lower dollar and lower rates. Even if the Twitter sphere and the price action doesn't reflect it yet, the data is changing. You have to be aware of that. So for primary metals, which is my personal top in the list, we see automotive order demand continues to be consistent and on a steady pace. So go back to tariffs. Most of the imports for vehicles come from Mexico. We're going to put tariffs on Mexico, which means before those tariffs are starting to take place and affect cost bases and shipping and everything else for the bottom line in automakers, they're already getting the materials now before those tariffs take place. So my guess is for the next quarter or quarterly earnings announcements, particularly, we might see a breakout in primary metal stocks. And we're going to go over that later. But for now, I want to focus on the data that we're looking at right now. For textile mills, I don't really know much about the sector. I don't cover a lot of stocks in that sector. So, nothing much there. But we do see strong consumer demand and higher sales than 2024. So both on the trade, the commentaries, and the index itself, you can already see how the change is coming, the shift is coming, which is why the title was No Way Back in the headline of the presentation, the thumbnail. So now we see the services PMI, which if you saw from the last video, this covers more than 80% of the US GDP. So it's becoming more and more important of a report. And it's softening. And it makes sense to see it softening because as the dollar comes down, these domestic service companies are losing both pricing power and also consumer confidence. Because if you're a consumer and the dollar weakens, your buying power goes down. You're not going to want to spend so much on discretionary services, so much as you would defensive products. And that's where manufacturing shines. So let's go ahead and cover the two drivers that contracted the most. That being business activity, which contracted by a factor of 3.5%. And I meant to put the business activity on the left and then the ISM on the right. But anyway, they're overlapped with each other, so I guess it doesn't matter. So you can see that this 3.5% contraction drove the manufacturing or the services PMI itself lower. And I think the expectation was for 53 something, and it came out at 52. So it's softening quicker than economists expected. And as well, we're going to cover some of the commentaries, but if you've seen Meta, Google, and other tech companies, they've started to roll out layoffs. And why that happens and why that always happens is because these industries, these CEOs, these management teams, they understand that a lower dollar is not going to be good. It's not going to be a positive thing for the services sector in the economy. So I think, and maybe you should too, that this is starting to add up to the narrative and the shift that we're already spotting here. So moving on, risk in the market is rising, or I should say the interest to hedge risk. And let me explain what I mean. So with GDP swinging into contraction territory, and by that I mean last quarter, we reported a 2.3% growth in GDP. But PCE readings, which is inflation, essentially came in at 2.5%. So nominal GDP, 2.3, inflation 2.5. That means real GDP actually contracted by 0.02%. 0.2%. So what that means is we are swinging into recession territory, which would, of course, prove right the narratives that we're spotting between the different asset class price action and the spreads that we already covered. So you can see that shift in the markets becoming interested in hedging the S&P 500 and the commitment of traders report. You can see it in the bottom left. That red line at the bottom, that's the balance for inventory in S&P 500 futures. The red one covers commercial interest, commercial inventory. And commercials are the big banks and the prime brokers, the ones that handle most of the inventory. And as you can see, that balance of negative 758,000, or I think it's millions in that report, is the lowest that it's ever been since the recession, the great financial crisis, right, of 2008. And that says something. In green, you also have the institutional interest. So this is like hedge funds, wealthy individuals, pension funds, momentum money managers, and it's already tapped out to the upside. It's at the same level it was in 2009, in 2011, in 2019, right before COVID. So what this means is momentum money, momentum capital is the only one left in the market right now. So it's overcrowded. The bet, right? The bet that the market is still going to go higher is too crowded right now, leaving so much risk on the downside, which is, I think, why you see on the bottom right, equity risk premiums in white and the S&P 500 in orange diverging for all of January and all of February so far. So I haven't gone too far out. I didn't zoom out enough. But you can see that every time these two diverge, there's a sell-off or there's a small crash in the S&P 500, which makes sense. These are not the yields, these are the spreads. So the price difference between 10-year bonds and corporate bonds. And whenever that spread goes down, it means that risk in the market is being, it's being paid at a premium. So the market is seen risky, is seen as riskier than usual. So we have the spreads coming down, which means that risk premiums are up. The perception of risk is being more accepted, it's increasing. Yet the S&P won't do anything. So I think that there's something coming there, there's something cooking. And I think it has to do with the rotation. And of course, that brings us to the opportunity that we can now spot by connecting both the manufacturing and the services PMI. So with this, we arrive at defensive construction. And I'll tell you why. Residential construction is out. We do expect a recession in real estate. We expect a 30 to 40% haircut in property prices across the board. We actually wrote a newsletter post on it and a thread that covers all that. If you want to check it out, go ahead. I think you should stay away from buying a home until the end of 2025, maybe halfway into 2026. So just rent or Airbnb, do whatever you got to do, but don't buy, please. So why are we looking into defensive construction? And what do we mean by defensive construction anyway? This is more like energy infrastructure, electricity, utilities, oil and gas, all of that infrastructure spending that's going to come into the country because of two things. First, President Trump wants to bring back domestic oil production. There we go. We have to invest in infrastructure to allow for that production to come back in the first place. So that makes sense. Second, when we look at the ISM manufacturing, the top left table right there, we see that primary metals are the ones that expanded the most for 2 consecutive months, right? And then machinery, we had a breakout for January from 2 months of contraction. All of a sudden, we had a big expansion in the factor of 4. Moving down, we see that table of the average valuations, the average growth rates in EPS, and the average PEG ratios for the steel industry. Now, that long commentary on specialty is because we have a premium on the valuations for PE2s, and we have a lower than average PEG, which means to me that the market hasn't really priced in all the potential growth that specialty steel can deliver in the next 12 months. But when it comes to specialty steel, it's not just any type of steel. It's steel that it's used in infrastructure construction. Remember, when we have a big building, a big infrastructure project, you have to build it through concrete that has steel built into it for flexibility in case there's an earthquake, in case there's stronger than usual wind. You need that building to be flexible. And residential construction doesn't need that. Infrastructure construction needs it. So that kind of fits into the narrative here. So we move to that table below of building products, and we see two narratives that connect that thesis together. And first, the building products, home builders, you can see how, one, they're not looking to grow their EPS at above average, which is why they're being discounted on a forward PE basis. And also their PEG ratios are, they're not that high, which means that the market is not really pricing in whatever growth it's going to have. But the fact that it's being discounted tells me that the market doesn't even believe that home builders can have the sort of growth that is being projected by Wall Street. So that leads me to think that the place to be in construction is not residential. So now we go lower and we see building products wood. We see an above average EPS growth rate. We see an above average forward PE premium. And then we also see below average PEG. So if wood, lumber, whatever, plywood, is going to be growing, but home builders are not, and specialty steel is, we have construction breakouts. And it's not going to be in residential because we have the home builders not trading as they should. So that leads me to think it's going to be defensive infrastructure construction. So let's go drill deeper into that. We have the employment segment of the services PMI for January. And we see construction, it expanded by a factor of 2 in November, not too great. But it sped up in December to a factor of 5. And then in January, it was the highest or the biggest expansion in the services sector. And we can go back. If home builders are not trading and are not looking to grow the way they should, but specialty steel and wood is, where's all this employment going into? It's not going into residential. It's going into defensive or infrastructure construction. So that's what you see there in the employment. Now, when we go below, we see electric construction is the one industry that is pushing double the EPS growth rate. It's also pushing for a premium, the biggest premium in forward PE valuations in the construction sector. And look at that PEG, 0.5. It's not even close to the rest of the group. So we're, of course, going long electric construction, which ties up to the thesis of defensive infrastructure construction, not residential. So you can start to see how we broke all the narratives down. Recession calls for infrastructure spending. It calls for defensive investment. It calls for rotations into basic materials and industrials. And then out of all those industries in the sector, this is where we land. And of course, we have a respondent commentary tying it all together beautifully. Expecting considerable new projects to move to execution by the second quarter in the energy market within the US. That's what the construction sector said. So there we have it. I think by now we have the odds pretty well stacked in our favor. But we have to go through stock selection. We can't just go randomly pick any given stock in the construction sector. So we found the companies that are exposed to the U.S. energy infrastructure building, where they supply materials and labor and whatnot. So for those, we have MLM, which is Martin Marietta Materials. Then we have VMC, which is Vulcan Materials, and TX, a Brazilian steelmaker called Ternium. And with this, we have a preference for TX for a bunch of reasons, but mainly because it has the most discount. As you can see, it trades at 67% of its 52-week high, and its PEG ratio for 2026 is 0.2, where the average for the industry is 1.1. So a massive, massive discount, where no matter what happens with trade and tariffs, I think the worst case scenario is already priced in. So remember, we don't want to look at the premium stocks as we usually would, which would be Vulcan and Martin Marietta, because of the IVE and IVW growth versus value spreads. The market is calling for a rotation into value, into risk-adjusted setups. And I think that Ternium is the best one here. We could go for the momentum and the breakouts in Vulcan and Marietta. But in my opinion, I think Ternium is the best if that rotation starts to take place. So let's look at the setup in the market profile. We have a volume cutoff since 2024 at the sub 30 per share level. And that cutoff, just like the S&P 500 we covered in the beginning, calls for either responsive buyers, which it looks like we've seen them so far, and a swing back to liquidity. And liquidity is, this is subjective, but it's mostly rule of thumb covered by the VPOC, which is the volume point of control, or the red bar that you see for both 2024 on the left and so far in 2025 on the right. That brings me into the 35 level as an initial price target, right? Because the market has to go back to seeking liquidity. Then when the volume cuts off again is at the 40 mark. So essentially, we have a reasonable price target or price range between 35 and 40. And from today's price, I think that's a pretty good deal. And, this is also a tariff opportunity because tariffs on Mexican steel might turn the country on more of Brazil's steel being the biggest supplier in Ternium. So as you can see in the quarterly earnings presentation, 52.6% of Ternium sales and steel exports go to Mexico. So you can see how a bigger tax or tariff on Mexican steel to the US and back and forth might turn the country into Ternium to provide them with the steel that they need. And that way they could decouple from the US trade and also satisfy Mexico's demand. Also, Ternium provides steel to China and the US as well. So both countries that are looking to increase their infrastructure spending and building, I think those are pretty good tailwinds for this stock, honestly. And at the risk reward that we see right now, it's amazing. We also see this stock being an ADR, an American Depository Receipt. We have a currency impact in the way that if the dollar goes down, then Ternium's stock price will go up as a result. Because if the dollar weakens against the Brazilian real, then Ternium, being an ADR stock, will automatically go up. So we have a tailwind right there. And also, fundamentally, as I say here, if a stronger Mexican peso or Brazilian real comes into play, then that would also boost the value of Ternium's revenue, operating income, free cash flow, and of course, earnings per share. So being the case that we have earnings coming out on February 19th, I think that management should, in some shape, way, or form, mention this catalyst, this currency tailwind in their presentation or earnings call. If not, then I hope that they mention something about tariffs and how Mexico might call upon them to diversify the supply chain and capacity outside of Mexico with the US tariffs. So in case that we're wrong, we do want to hedge with a potential long in MLM or VMC, risk adjusted, delta adjusted, so that if we're wrong, then we can still ride the momentum in those stocks, even though they're priced in already all the potential growth for 2026. So that would be a setup. Of course, there are many other ways to hedge it, but that's, broader. That's another scope for another video. I think for now we covered everything we need to cover. So you can see it in the chart. It's at a volume cutoff as well, and we have the earnings coming up. And analyst price targets are at 47%. So it's even above the VPOC and the cutoff that we gave you previously. So hope that made sense to you. And without anything else to give you, I hope that you figured out how important it is to follow along both the manufacturing and the services PMIs every single month, because it can lead you to the best trade ideas that we not only put together for ourselves and our capital, but also write about in a digestible way. And it allows us to make $10,000 a month and more by selling these ideas to the right audience and being able to explain them in the right ways to a non-financial audience. So anyway, with that being said, that's another video that we made in this channel. If you want to go check it out, it'll really help you if you're just getting started and trying to figure out what the first step should be in your career. If you want to hit us up, I'd love to get to know you better. I'd love to hit up a chat with you. I'm always open to that. So for that, those are our socials on Instagram. And if you want to send us an email, that is our investigroup.io email. And also, of course, I'll have to send you to our newsletter because everything we just covered doesn't compare to everything that we cover 3 times a week for free in our newsletter. So yeah, guys, with that being said, it's been a pleasure. I can't wait to see you next time. And I hope you got a lot from this. Let's see how your own ideas stack up with the breakdown that we just did today. Remember, the link is in the description below where you can download your free Excel and PDF model so you can follow along and come up with your own trade ideas. On that note, I'll see you guys in the next one.